There's a retirement account move called the Backdoor Roth that lets any earner, even someone pulling $500,000 a year, grow their money completely tax-free for life. Pull every dollar out in retirement without owing the IRS a single cent, and your financial advisor, your bank, and every personal finance class you ever sat through never once mentioned it exists. Here's the thing. The government put income limits on Roth IRAs. Single and making more than $161,000. Married and clearing $240,000. The door closes. You hit a certain income level and the best retirement account in the country just disappears off your options. So most high earners shrug. They dump money into taxable brokerage accounts, pay capital gains every year, and hand the IRS another cut when they finally retire. They follow the rules they were taught. But those aren't the only rules. They never were. The strategy is called the Backdoor Roth, and it's not a loophole. It's not aggressive tax planning. It's a two-step move the IRS has explicitly blessed in writing multiple times. Here's what it actually is. A traditional IRA has no income limit for contributions. None. Anyone at any income level can put money in. At higher income levels, that contribution isn't tax deductible, but that doesn't matter here because you're not keeping the money there. You contribute to a traditional IRA with after-tax dollars, and then, almost immediately, you convert it to a Roth IRA. That's the backdoor. You didn't go through the income limit gate. You went around the wall entirely, and on the other side, tax-free growth, tax-free withdrawals, no required minimum distributions, ever. Let's run the actual numbers so this stops being abstract. You're 40 years old and your income is $300,000. You cannot contribute directly to a Roth IRA. The income limit locked you out. So here's exactly what you do. Step 1, you open a traditional IRA and contribute $7,000. That's the 2024 limit. You don't deduct it. You're paying tax on it now up front, which is fine because that was always the plan. Step 2, you wait a few days, a week at most. Then you convert the entire balance to a Roth IRA. Because the money went in after tax and hasn't had time to grow, you owe essentially nothing on the conversion. The IRS taxes you on gains at conversion. You have none. Step 3, that $7,000 now sits in a Roth IRA. It compounds at 7% a year for 25 years. That's nearly $38,000. Every single dollar of that growth, tax-free. You pull it at 65 and owe the IRS nothing, not a dime. And here's where it gets interesting. If your employer offers a 401(k) with after-tax contribution options, there's a version of this called the Mega Backdoor Roth that can shelter up to $46,500 more per year on the exact same principle. That's a different file. But hold on to that number. So who's actually doing this? High-income professionals, doctors, lawyers, engineers, business owners. People who hit the income ceiling and simply assumed the Roth door was shut. The quiet irony is that the people most capable of maximizing a Roth, the ones who don't even need the upfront deduction, are the exact people who have been told they can't have one. And why didn't your financial advisor ever bring up the backdoor? Because a tax-free account is largely self-managing. There's nothing to charge you fees on. A managed taxable brokerage with annual rebalancing, dividends reinvested, and tax loss harvesting. That's how the advisory industry earns its keep. A Roth IRA you never touch is excellent for your future. It is not excellent for their revenue. Now the catch, and there is one worth knowing. It's called the pro rata rule. If you have other money sitting in a pre-tax traditional IRA, the IRS doesn't let you separate it cleanly. The conversion gets taxed proportionally across your total IRA balance. That can turn a clean backdoor into a messy, unexpected tax bill. The fix is simple. Roll your existing pre-tax IRA into your employer 401(k) first, then execute the backdoor. The IRS has published guidance on every step of this process. This is not a gray area. It is a door they built into the tax code. They just never bothered to hand you the key. Think about what this really means over a career. You've been paying income tax your whole working life. The Roth is the one account that says, fine, you paid, this money is done, no more. But most high earners never knew they could still walk through that door. The income limit scared them off and they never looked for the side entrance. Every year they skipped, this was another year of taxable growth instead of tax-free compounding. The cost of that gap over a full career runs deep into 6 figures. And there is something I haven't said yet. The Mega Backdoor Roth does this at 10 times the scale through an account most of you already have sitting at your employer. That's the next file.